Income tax is a percentage of your income collected by the government to fund services and programs. Many states also have an income tax, but not all. Okay, the states that don't have an income tax have higher sales taxes. Taxes are usually withheld from your paycheck. The amount is an estimate for what you will owe in the end, and that means the end of the year. It's like a savings plan for the taxes you will eventually owe. If not enough is taken out, you will owe. If too much is taken out, you get a refund. Okay. So some people will talk about somebody got a certain refund. That probably means they just had more taken out than they should. Okay. Federal taxes are a percent of your taxable income for January to December. Taxes for the previous year must be filed by April 15th. Gross income is the total income. Okay, and that means before taxes. Adjusted gross income is the income minus allowable amounts. Exemptions are a fixed amount that can lower your taxes that are due. Standard deductions are an amount that you can subtract that lowers your taxes owed. Itemized deductions are listed separately. These include charitable donations, medical bills that exceed 7.5% of your AGI, okay, mortgages, mortgage interest. Okay, this should really say mortgage interest and property taxes. You can only take either the standard deduction or the itemized. You choose the bigger one because that lowers your taxes. Filing status depends on your household. Single is not married. I don't know why I wrote not married twice. Okay, not married and no, not married and no dependents. Dependents are people that depend on someone else for their support. Okay, children are dependents through the age of 17 generally, unless they're in college, or permanently need someone else to care for them. Okay. Head of household means not married, but has a dependent. You can also file married or married filing separately. Okay, example one, a single man earned wages $46,500, earned $18.50 in interest from a savings account, received $15,000 in winnings on a TV game show, and contributed $2,300 to a tax-deferred savings plan. Okay, tax-deferred means the taxes will be calculated later. He is entitled to a personal exemption of $40.50 and a standard deduction of $6,300. The interest on his mortgage is $6,500. He paid $2,100 in property taxes. He paid $18.55 in state taxes. He gave $3,000 to charity. Okay, so his income would be the wages plus interest that he earned plus the game show winnings. Okay, so that's the gross income. Adjusted gross income, AGI, the tax deferred savings means we're not going to pay taxes on that $2,300. So the AGI, we take the gross income and subtract the tax deferred savings. So we're going to pay taxes on $61,050. Okay, but first we have to subtract our deductions, the itemized deductions, the interest, the property taxes, state taxes, and charity, okay, all count as deductions. Okay, so the taxable income is the AGI minus the exemption and minus the deductions. Okay, so this is what we're going to pay taxes on. Okay, taxes are called on a graduated scale. Okay, so the table that we're going to be using, the first portion's taxed at 10%, okay? The next amount of money is taxed at 15%. So the more money you make, the higher percentage your taxes are on that higher money. And it continues to go up. The government changes the dollar amount every year, okay? And sometimes they change the percentage. They actually also did away with exemptions, and it also depends on your filing status, okay? Now, the reason I have exemptions in here is because this book was written in 2016, so we're going to follow along with that. It's just that the filing status is the exemptions are not really in real life anymore. Okay. All right. A single person who has no dependents has the following income and deductions: gross income, adjustments, okay, a tax deferred IRA. So our deductions, we have 7,500, 2,200, 2,400, 1,500. Okay, so we've got mortgage interest, property taxes, gifts to charity, and medical bills. Okay, so our adjusted gross income is the gross income. We subtract the adjustments. Okay, so the adjustments were 4,000, and that comes from the tax deferred IRA. Okay, that means we're going to pay taxes on it later. Okay, we cannot deduct our medical bills because it's got to be more than 7.5% of AGI. 7.5% is 0.075. The AGI was 58,000. We found that right here above. And so that's 4,350. So the medical bills were only 1,500. Okay. So we can only deduct, okay, our mortgage interest. Okay. What's the 2,200? The 2,200 was property taxes. The 2,400 was charity. Okay, so this is our total deductions. Okay, so we take our income minus our exemption minus our deductions. Okay. Okay, and that gives us, actually, we already subtracted the 4,000. Oh no, the 4,050 is the exemptions, okay? And then our deductions, okay? So now we look at this table. We said that this was a single person, okay? So up to 9,275 is 10%. So we need to find 10% of 9,275, so we multiply. Plus, next we have to do 15% of the money that's between 37,650 and 9,275. Okay, so up to 9,275 is 15%. And then 25% is what's above that. Okay. Now, we take that 41,850 and we subtract 37,650 because this is our total income. Okay, the income we're paying taxes on is 41,850. Okay, they didn't make up to 91,000, so only 40. That last bit gets taxed at 25%. Okay, we do what's inside parentheses first, so you would do your subtractions. Then you would add up all of those amounts, and that would give you your owe taxes 6,233. Okay, a tax credit means it comes off of what you owe, so the tax liability you would subtract to get the total. Okay. Now, in real life, you would compare that to what was taken out. Okay. If 6,000 was taken out per year, this is your yearly taxes owed. okay? If 6,000 was taken out, you'll get some money back. If only 5,000 was taken out, you still would owe some. Okay? If more is taken out, you get a refund. If not enough is taken out, you have to pay. Okay? Other things are taken out. FICA stands for Federal Insurance Contributions Acts. Sometimes these are broken down into the two parts, Social Security and Medicare. Social Security gives payments to retirees and people with health problems, and eligible dependents of deceased persons, and citizens with an eligible disability. Medicare is health coverage for people 65 and up. Okay, so here is the percentage rates for Social Security and Medicare, which combined is FICA. Now, on your paycheck, you probably will see them separated. Someone that's not self-employed has different taxes than somebody that's self-employed, okay? So self-employed is just this last column. So someone who's not self-employed, what is their FICA to be taken out if their income is $150,000? Okay, so it says the first $118,500 is 7.65. Okay, so we multiply that and we get that this is what's taken out. Okay, now this is the yearly amount. Okay, what your company's going to do is break that down into the number of paychecks. Okay, now they made over 118, so we've got to figure out that remaining amount. 150 is what they made. We've already done the taxes on the 118,500. So the remaining percent is 1.45%. Okay, so 0.0145. The remaining amount is 31,500. So we have to pay 1.45% on that. Okay, so the total would be the 9,000 and the 456. Okay, so this is annual. So what your company does is break that down to estimate it, to divide it into your paychecks each time. Okay. Taxes for working students. A job pays $15 per hour. You work 20 hours. Your employer withholds 10% of your gross pay for federal, 7.65% for FICA, 3% for state. Okay, so what's our weekly pay? 20 hours per week times 15 per hour is $300 before taxes. Okay, so before taxes is your gross pay. Okay, 10% of that 300, 0.10 times 300 is 30. 7.65% of the 300, 0.0765 times 300 is $22.95. 3% for state, so 0.03 times 300. So what are our total taxes? The federal plus the FICA plus the state is 61.95 total taxes. Okay, so what is net pay? We take 300 minus 61.95, and that gives us our weekly pay. Okay, we note that the paychecks often have FICA broken down into our two separate pieces. Okay, Social Security and Medicare.